Hello everybody, welcome to episode 6. We're going to be talking about refining the trade model and also adding the time element to it. In refining the model, I'm going to be discussing where not to trade the model and when not to trade the model. Let's first dive into when not to trade this model. So before high impact news, I typically do avoid price action, things like FOMC, CPI, NFP release before Jerome Powell speaking if he is. In FOMC, if it's just the statement, typically I'll wait like 30-ish minutes. If Powell is speaking around 2:30, typically I'll wait towards around like 2:50-ish. I just like to wait for the volatility to settle. Before CPI, I'm just not trading. If that's at 8:30, I'm not trading before that, and I'll typically just wait towards the 9:30 open or after. Same with NFP release. There are ways to trade it like directly after, but it's just best to let the volatility settle. What I've noticed is on these days, what you can get is if you have a bullish bias and you're already anticipating for price to trade up to a level up here, let's say you're looking for buy side, and then price returns beneath a level of sell side liquidity, you get a change in the state of delivery, creates the fair value gap, right? It breaks above the order block. What I've noticed with this model is that price can do that, and then it could do one more run on stops and then go to where you were already expecting price to go to. So I typically just avoid trading before these days because of that. So I've had numerous times over a series of months where I've traded a change in the state of delivery. I'm already anticipating price to trade up to here. Maybe price is trading down, right? This is a level of sell side liquidity and price returns beneath there. It's a very clear structure for price going higher. It fails, does one more run on stops, and then you get displacement in that direction towards the buy side. So that's why I avoid trading at these times. What I'd use is forexfactory.com. There is also the news tab in the Discord, which you can follow along. Typically, I will alert it in the beginning of the week where I'll just say this is the news for the week. There are times when it's more high impact news. I'll post it in intraday ICT, like things like CPI. I'll just say, you're better off avoiding it because it's not worth. Let's say you're averaging a 60% win rate. You want to spend those 4 losses out of 10 on high probability setups. If you're just wasting that's kind of how I view it. If you're just wasting one of those losses in a low probability condition, it doesn't make sense. So that's why I avoid those times. Now we could dive into where not to trade this model. If this is in a market maker sell model, like if price is going to trade lower and you're already anticipating for price to take out this sell side liquidity, let's say it hit a higher time frame level of buy side up there, price created a change in the state delivery. We're on a 30-minute, let's say up here, see how there's like a lower time frame model in there. Let's say that's like a 5-minute or like lower time frame, maybe like a 3-minute. When price starts to trade lower here and it takes out this level of sell side, but you're still anticipating for price to trade lower, a big misconception is even though you have a bias that price is going to trade down to this level of sell side liquidity, as soon as price takes out this level of sell side, and then it does something like this where it trades higher, right? Starts to trade lower, and then it creates a bearish change in the state delivery here. I'm not trading that first model as soon as it takes out the sell side. Why? Because price has a tendency to return back to liquidity over here. So what can typically happen is price can take out sell side. I need to see it take out a level of buy side that price created up in here. Okay. So it runs over a short-term high, creates a change in state delivery. A lot of people are getting short on this, anticipating for lower prices, thinking that this is a break in market structure lower. What can typically happen is that price returns back higher, takes out the liquidity here, and then heads lower. So you notice in the notes that I have when bearish and price hits sell side liquidity, wait for a run on buy stops before looking short. So once it hits sell side liquidity, there's some times where it's just going to run without you and it's just going to run straight lower, but you're going to save your time. You're going to save yourself more times than not trying to just short that initial change in the state delivery beneath the sell side. So this has saved me a lot. What you can do is you can wait for price to return back to the buy stops here and then hunt for a lower time frame change in the state delivery at this buy side and then target this level of sell side now. And also you could target this. This would be like the low hanging fruit target. It's just the easiest target. And then you could also target this level here. Typically, price will return back to the buy stops, take that out, and then once it expands lower and heads for this low, I don't want to see price return back for this high before taking out this low. Also, I didn't mention this in the beginning. We're going to be talking a little bit about stop placement and trailing your stop in this video. More so about trailing your stop. I already did talk about stop placement. So again, when price hits sell side, I'll wait for a run on buy side, then hunt a change in the state delivery model in here. Similarly, if we just inverse the chart, when I'm bullish and price hits buy side liquidity, wait for a run on sell stops before looking long. So if I'm anticipating for price to run up to the buy side liquidity up here and price takes out buy stops right here, as soon as it takes out that level of buy side, sometimes you'll get a change in the state delivery initially. What I need to see is I need to see some type of run back on sell side liquidity. So when price is expanding higher here, creates that change in the state delivery, I'm not longing the first change in the state delivery above buy side. I need a retracement to take out at least some minor level of sell side. It doesn't have to run back all the way to take out all the engineered liquidity. I don't require that. I just need some type of a run back on sell stops. So once it does that, then I hunt for a change in the state delivery. And again, it's not always going to take out all the liquidity. Sometimes you'll get something that looks like this, where we just have such a little minor swing low in here. Price will take that out like this, and then right here I'm hunting for the lower time frame change in the state delivery. If these lows aren't too close to each other, then I only require one of them to get swept. So see how we have the relative equal lows here? I'd require that to get hit and then hunt for a change in the state delivery. This is if I'm already anticipating for buy side all the way up here. Why am I not anticipating for this low? Because if price is in a strong buy program, it's not always going to take out all of these lows that were set in place, because a lot of these lows in here, especially in a discount, smart money's buying those and then looking to rip price up into the buy stops up here. So when bullish and price hits buy side, as soon as it hits that, I'm not trusting that first model. Another thing, let's say we have something like this, where we have all of these lows clustered close together. Another thing to add, where not to trade this model. When price does this and it retraces back down, it hits buy side liquidity, and then you have these lows clustered very close together. Okay, when they're this close together, I wait for them to all get hit, because if price were to just come back down, take out this low, it would leave these lows way too close to each other. So when there's perfect engineered liquidity and I'm expecting higher prices, I'd require that to all get taken out. In this case, this is like perfect engineered liquidity because it's a bunch of lows clustered close together. There's going to be retail sell stops beneath here. So I'd wait for them to get taken out and then hunt the change in the state delivery down here. That is when there's perfect engineered liquidity, like when it's literally like touching. Okay, I'll show an example of that. Actually, let's show an example of that right here. So you can see that we do have these relative equal lows. They're very close to each other. Notice how we have another low down here. We posted this in the Discord anticipating for higher prices using this. We had these relative equal lows. Notice how they're so close together. When price starts to expand higher from here, I'm not longing this change in the state delivery. Even though I'm bullish on the higher time frame, even though it created a change in the state delivery here, I don't trust this because it left behind these two perfect equal lows. Okay, sometimes if there's SMT divergence, like let's say ES was down here and then NQ was like this, so ES made, or okay, NQ made a higher low, we'll say ES is in red, ES made the lower low. In that case, then it can leave the relative equal lows, but in this case we didn't have that. So we have the perfect relative equal lows right here, pulls back up, takes out the buy stops, and then expands lower, takes out the sell side liquidity. This is still pretty far away, so I'm not worried about that. And then I'm anticipating for price, once it creates that lower time frame change in the state delivery, if we zoom in on that, that occurred in here. So price took out the liquidity, started to expand higher, created that fair value gap right there. So this little imbalance broke above the order block. Now it's going to start attacking the buy stops like we talked about in previous episodes. So going back to over here, I do have adding the time element. So between 9:30 to 10:30 a.m. So like I said, I don't typically use macros. There are macros that you could use, and it's kind of still applying the same logic ICT talked about in his macro video on his YouTube. I believe that was in the 2023 mentorship. He said macros are likely to expand price towards liquidity, or you can get a change in the state delivery during that time, or it's going to seek to rebalance an inefficiency. So he hasn't taught much on macros. Sometimes I will use them, like if I'm anticipating for price to trade higher towards a level of liquidity already, and then it's during a macro, then I'll say, okay, well, during this time I'd like to see speed. But sometimes it can just consolidate during those macros. So I don't use them a ton, but here are some that you can use. You could use the 850 to 910 macro. So here are some macros in the AM. You have the 950 to 1010. A lot of times I do see a setup during that time frame. If we move back to over here, this was between the 950 to 1010 hour. Moving back over here, we have I'm marking out the 930 to 1030. I'm going to talk about that in a second. But so we have 850 to 910, 950 to 1010, 1050 to 1110, 1150 to 1210. Then there's in the PM, I believe there's the 315 to 345, 250 to 310, and then I think 130. I can't remember if it's 110 to 140 or just the 130 macro. Again, I don't really use them a ton. They are things that you could use as confluence for what we just talked about, looking for price to expand towards liquidity, rebalancing an efficiency, sometimes just create like a manipulation swing. It's typically times where you look for acceleration, but again, I'm not claiming to be a master of macros because I don't use them a ton. I just use them as a confluence here and there. Right here, I said adding the time element 9:30 to 10:30 a.m. Every day there is a setup that forms between this time, or there is a setup that's already in play reaching for liquidity. Sometimes it doesn't always take out liquidity. Most of the time it does. So I'm going to show you guys an example of that. So here was today, 9:30 to 10:30 a.m. Sometimes what can happen is it doesn't offer a setup. So here's a level of buy side liquidity. Sometimes during that 9:30 to 10:30 period, if price is down here, it'll just be expanding for the buy side the whole time. Most of the time, 90% of the time, I'd say at least, there is a change in the state delivery that occurs between the 9:30 to 10:30 hour. On the occasion, it's just expanding for liquidity at that time. I'm going to show you guys what I'm doing with these fibs here in a second. So between 9:30 to 10:30, you can see a price took out liquidity. It doesn't always take out liquidity and create a change in the state delivery, but 90% of the time, you're going to see some form of change in the state delivery between 9:30 to 10:30. Here, price took out liquidity. Again, I'm not saying it's going to take out liquidity always at that time, but 90% of the time, it's going to create a change in the state delivery between this hour period. So between 9:30 to 10:30, you can see this is at 9:46. Price closes beneath that order block. Now, why am I not using both? Because this created the change in the state delivery. So we have we have two up close candles, but this one up close candle was the lowest one. Price closed beneath that with a fair value gap. This was above buy side liquidity here. I wouldn't have taken this personally. I'm just showing an example. The reason I wouldn't have taken it is because there's perfect engineer liquidity above. So this is an example where I would have missed the setup, and I did miss it today. But I know using this strategy, more times than not, it'll save me. So there is liquidity. If I zoom back out, you'll see that we do have these perfect relative equal highs. So you're going to save yourself more times than not using that. But between the 9:30 to 10:30 hour here, we have a change in the state delivery, a fair value gap that forms, and then price starts to attack the sell side. This would be like a low-hanging fruit target. You also have the sell side over here. You have the sell side here, and then you have the sell side right there. So it will typically reach for liquidity after creating change in the state delivery between that time period of 9:30 to 10:30. So this was around 9:46 where it created that order block, closed beneath it with a fair value gap. It's likely to start attacking that liquidity. Now, it doesn't have to reach the liquidity within that time period. That may be a question you may have. It's just that the inception of a change in the state delivery typically does occur within this time period. And just to be clear, this is something that I personally use. I don't know if ICT has ever taught something like this. He has talked about the first hour of the market being open being a key time to trade, but I just want to make that clear. This is just something that I have personally found beneficial in my own trading, looking for setups between this time period. I'm not claiming that this is something that ICT teaches. This is something just personal that I've found using his concepts. So that's the time element that I typically refer to. Again, you can use macros. There are kill zones, 8:30 to 11 a.m. is the AM kill zone. You have lunch session, and then you have the PM kill zone, which is 1:30 to 4 p.m. So now we're going to talk about stop trailing. And I typically do not trail my stop until price is close to the target area. Here's an example. If I was trading this, price created a bearish change in the steady delivery. Notice it returned back up into this order block right here on this pump back up higher. It started to expand lower. If I'm targeting this low, let's say I'm targeting the sell side liquidity, pull down here. I'll make it blue. Let's say I'm targeting this sell side liquidity and I got short in this change in the steady delivery. Once price reaches towards 50% of the move, this is an area where I could trail my stop. So typically, if price creates a change in steady delivery, I'm not saying I always do this, but in a good amount of situations, I do not want to see price return back up all the way higher when this occurs. I'll show you in a second. Creates the change in the steady delivery, returns back to the order block, starts to expand lower, and if you draw a fib from your draw on liquidity target to the high of where the change in steady delivery started, okay, when price reaches 50%, I can trail my stop to the propulsion block high. So this propulsion block right here, if it already reaches 50% towards that draw on liquidity, and all I'm doing is drawing my fib from the change or from the draw on liquidity target up to the high. Okay, so clicking it on the draw on liquidity target, dragging it up to the high, the change in the steady delivery. Once it reaches 50%, if there's a propulsion block there, ideally I don't want to see it return all the way back up. If it were to pull back up and take out that high, either I'm in a high resistance liquidity run condition, which is a condition I don't even want to be trading in the first place. Most of the time though, if it takes out that high, it's just going to run for the stop up here. So that's why if I was trading short on this change in steady delivery and I initially had my stop above this previous high and I'm targeting, now this is a pretty big RR situation, so let's just act like I got a crappier entry since the RR is already good. Let's say I got in right about there. I feel like that's realistic. So if you're targeting the sell side liquidity and it reaches 50%, this is a point where I could trail my stop to the propulsion block, which is just an order block right here that formed that retested a previous order block. So I'm trailing my stop from the high down to the high of the propulsion block. So this up close candle in here retested this order block. So this forms a propulsion block, and it's an order block, but it's classified as a propulsion block. Price starts to trade lower. Once it taps that, again, that's where I can trail. Once it reaches that 75% mark towards that draw on liquidity, this is an area where I could either keep my stop where it is or potentially trail my stop to break even, because if it reaches 75% towards my draw on liquidity, I don't want to see it run all the way back up. Oops. I don't want to see it run all the way back up to my entry. Because if it were to run all the way back up to my entry, what would happen here? Well, we'd have a high that forms back to my entry. We'd have the previous high up here, and now we have three relative equal highs. So this is just a time where I'd likely either get stopped out at break even, which I'd be okay with, or still have my stop above this previous high. So at 50%, I can trail my stop to the propulsion block high. It's going to be this blue level. If it reaches 75%, I can either keep my stop there or trail it to break even. Again, there are going to be times where this is not perfect, and it could just pull back up. You get an extremely deep retrace, and then price trades lower. More times than not, you're going to save yourself with this. So that's going to be it for this video. Hopefully you guys found this insightful, and stay tuned for episode 7 tomorrow. See you later.